The theme for today's conference is extremely. Our conference for the day is split into 4 sessions. We start with the inaugural session and then proceed directly to the first technical session. Thereafter we break for lunch and then assemble at 2 p.m. for the quiz, followed by the second technical session, which includes the panel discussion. During the day we shall have the privilege to hear the words of wisdom of our experts, and I am sure all of us will have lots to take back when we leave the hall at the end of the conference. Now I request CA Rajesh Kumar Agarwal, President DTPA, CA N.K. Goyal and CA D.S. Agarwala, Chairman and Co-Chairman of the Conference Committee, to escort CA Ranjit Kumar Agarwal, President Institute of Chartered Accountants of India, our chief guest of the conference, to the dais for the inaugural session. I also request CA Barkha Agarwal, Senior Vice President DTPA, and CA Mahinder Agarwal, Secretary DTPA, to come on the dais. I request everyone to please rise for the national anthem.
अधिनायक जय हे भारत भाग्य विधाता, पंजाब सिंध गुजरात मराठा द्राविड़ उत्कल गंगा, विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा, तव शुभ नामे जागे, तब शुभ आशीष मांगे, गाहे तब जय गाथा, जन गण मंगलदायक जय हे भारत भाग्य विधाता, जय हे जय हे जय हे जय 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 हे.
I would now request our Chief Guest, CA Ranjit Kumar Agarwal, President, Institute of Chartered Accountants of India, to inaugurate our conference by lighting the lamp. I request the others on the dais to proceed for the lighting of the lamp. I also request our guest speakers to join the lighting of the lamp. Also request Central Council Member of ICI and Chairman EIRC, Sushil Goyal and Sanjeev Sanghi ji, to come forward for the ceremony. I also request Himanshu Bhai to kindly join on the dais.
वक्रतुंडाय गौरीतनयाय धीमहि, गजेशानाय भालचन्द्राय श्रीगणेशाय धीमहि,
श्रीकरन्दाय वक्रतुंडाय गौरीतनयाय धीमहि, गजेशानाय भालचन्द्राय श्रीगणेशाय धीमहि.
गणनायकाय गणदैवताय गणाध्यक्षाय धीमहि.
Thank you all. I now request CA Rajesh Kumar Agarwal, President DTPA, to deliver his welcome address.
Respected Chief Guest, CA Ranjit Agarwal ji, President ICAI, CA Dr. Kirisa Oza ji will be joined online, CA Jatin Christopher, Mr. Bharat Shah, he will join later, Mr. Ajay Bagga, Mr. Ashish Somaya, Mr. Sandeep Jain, Chairman CMK Goel, other dignitaries on and off the dais, senior officials from Income Tax and GST Department, present and past Central Council member of ICI, Chairman and other office bearers of ERC. Present and past Regional Council member of ERC of the ICI, past President of DTPA, my colleagues in the executive and annual conference committee, members from press and media, distinguished guests and members. I, on behalf of DTPA, extend a very hearty welcome to all of you. DTPA has evolved over years and association committed to its motto, Jnana Vakyam Cho Nyartham, which means knowledge and togetherness for justice. With a great history spanning 42 years, our association is recognized as one of its premier bodies of professionals, consisting of approximately 1,900 members. As we are transiting to a dim taxation regime, we have seen that the real income is shifting towards estimations, and this is leading to litigations. It's time to ponder whether this step is in the right direction or causing discomfort to the stakeholders. Keeping this in mind, we have organized this annual conference 2024, the flagship event of our association, on the theme heading towards dim taxation regime. I deeply honored to welcome CMD Kumar, President of ICI, for kindly accepting our humblest request and grace and inaugurate this conference as our chief guest. I am equally thankful to our guest speakers and panelists for the conference, CA Dr. V. Sahuja, CA Jatin Christopher, Mr. Bharat Shah, Mr. Ajay Bagga, Mr. Ashish Somaya, and Mr. Sandeep Jain for sparing their valuable time. Their august presence is a matter of great inspiration, and their words of wisdom will help professionals contribute their skills to development and growth of the country. On this occasion, we will also Villagers of India, a publication on income tax case study, a publication on GST, and members directory. Express my gratitude to the authors of contributing their write-ups and all chairpersons and co-chairpersons of subcommittees. Express my gratitude to C. Narendra Goel, past president and chairman of the conference committee, and D.S. Agarwal, co-chairman of and immediate past president. Of his behalf, executive committee members and other conference committee members and constant input, efforts and guidance in organizing this conference. I would also like to thank the support partners, members, Bhutan Pad and everyone had involved in this conference for their contributions. Finally, I thank all the delegates for participating in this conference and hope that you will benefit from it. Thank you.
Thank you, President. The theme for today's conference is heading towards deemed taxation regime. I would now request the N.K. Goel, Chairman Conference Committee, to kindly deliver the theme address.
A very good morning to each one of you. On the dais, Honorable President ICI, Sri Ranjit Kumar Agarwal, President DTP, Sri Rajesh Agarwal, my colleagues, Sri D.S. Agarwal, Sri Barkha, Sri Mahendra Agarwal, our guest speakers, Dr. Girish Ahuja will be joining online, Mr. Jatin Christopher, Mr. Bharat Shah will be joining shortly, Mr. Ajay Bagga, Mr. Ashish Somaya is also on the way, will be joining shortly, Mr. Sandeep Jain, guests from ICI and EIRC, past presidents of DTPA, past president BCAS, Sri Himanshu Krishnadwala, who was in KOLKATA, and we have the privilege of his being here, guests from Income Tax and GST Department, sponsors, seniors in profession and fellow members. A very hearty welcome to you in this annual conference 2024. As all know that this is the flagship program of DTPA, and we try to organize this event with utmost care and efforts to make it comfortable, knowledge enriching and interesting. Therefore, bearing this mantra in mind, we have planned the technical sessions with the theme heading towards deemed taxation regime. The topics for discussion in income tax are deemed income tax versus real taxes, the dynamics of modern taxation, and deemed supply and valuation, a Pandora's box in GST. In second technical session, to make the session interesting, we have an interactive professional quiz followed by 2 deliberations on capital market, identifying multi-baggers with exit strategy, and the second one being secrets of success in capital market, followed by a panel discussion on markets at 2030. You have noticed that there is a shift from micro-analysis of a particular section in income tax or GST to a macro-level discussion on the basis of taxation in the first technical session. The basic object of this change is to understand the basis, object, the scope of future taxation. Nowadays, we see the focal point of taxation gradually shifting to deemed tax and fair value tax, contrary to the concept of real income taxation. The legislature, before doing so, must have done its homework, but we professionals and taxpayers need to understand the object, scope and future of this taxation regime. We trust the technical sessions will be interesting and knowledge enriching when we have none other than tax guru Dr. Girish Ahuja to speak from income tax perspective and CA Jatin Christopher on GST. Friends, capital markets are booming. The Sensex has risen 10,000 points in less than a year compared to the average 2-3 years it used to take earlier. And therefore, there is a need to understand ways of identifying multi-baggers and the exit strategy very carefully and the secrets of success in capital market as well. And we also need to understand what will be the future of this Sensex in or around 2030. We have 4 renowned personalities: Mr. Bharat Shah from Mumbai, Mr. Ajay Bagga from Mumbai, Mr. Ashish Somaiya and Mr. Sandeep Jain to enlighten us on these matters. We will be present in the hall at that very time. I thank you all the guest speakers for sparing their valuable time and deliberating this conference. Ladies and gentlemen, this conference is a result of hard work of Annual Conference Committee for over 75 days. And I thank each one of them in bringing things to this shape. I especially thank past President Sanjay Bajoria ji, P.R. Kothari ji, Vikas Parak, D.S. Agarwala, M.C. Jagwain ji, Anand Tibriwal ji, Arvind ji, Agor ji, Ramesh Chokhani, all DTP office bearers and conference committee members, especially Hitesh Vimal, Sujit Sultania, Saib Singh Chaudhary and Vivek Jain. Thanks to all sponsors and donors and logistic vendors. Last yet most important, I owe my duty to thank all fellow members and participants in this seminar, without whose support we cannot organize such a wonderful conference. With these words, I welcome you all once again. Thank you. Jai Hind.
Thank you, Goyal ji. Today we have with us our very own CA Ranjit Kumar Agarwal, President Institute of Chartered Accountants of India, as our chief guest. CA Ranjit Kumar Agarwal does not need any introduction since he is family to us and we all are aware about his achievements. A seasoned professional with strong organization skills, having a penchant for excellence and academic acumen, CA Ranjit Kumar Agarwal is the 72nd President of the Institute of Chartered Accountants of India for the year 24-25. While serving as the Central Council member since 2016 and then as Vice President in 2023-24, he has led the profession from the front and has shown his unwavering commitment to the profession. As the erstwhile chairman of the Professional Development Committee, he played a pivotal role in the successful implementation of UDIN, which is a significant milestone for the institute. Mr. Agarwal's tenure as the chairman of the Ethics Standard Board was the formulation of a new code of ethics after a decade, a testament to his expertise and commitment to the upholding ethical standards with the profession. I would request CA R.N. Rastogi ji, past President DTPA, to present a shawl to our chief guest, CA Ranjit Kumar Agarwal.
দাদা একটু সাইড করে দাদা একটু সাইড দাদা এদিকে চলছে। দাদা একটু সাইড হয়ে গেলে আর ওয়েট করব কি?
I request CA Sanjay Bajoria, past President DTPA, to present CA Ranjit Kumar Agarwal ji with a memento.
দাদা দাদা একটু সাইড দিয়ে, একটু সাইড দিয়ে দাদা, একটু সাইড দিয়ে।
Thank you, sir. Thank you, sir. Ranjit ji does not need any introduction, but thoda so बोलना ही पड़ेगा. I now request Shyam to kindly take the Drishti wing.
तथा सृष्टि, meaning as is one's vision, so यथा दृष्टि तथा सृष्टि, meaning as is one's vision, so is one's experience. This timeless wisdom encapsulated within the verses of the Bhagavad Gita serves as the guiding light for the Institute of Chartered Accountants of India for the council year 2024-25. Assuming the office as 72nd President of the Institute of Chartered Accountants of India, CA Ranjit Kumar Agarwal, along with Vice President CA Charanjot Singh Nanda, anticipates his vision on the theme Drishti.
I am privileged that I am assuming the responsibility of an institution which is not an institute, but over the last 75 years, which is the world.
Drishti, which symbolizes a transformative journey, pulsating with innovation across the 7 pillars D, R, I, S, H, T, I. Drishti. One of the major focus areas this year is digitalization. Taking a lead in this area, ICAI has formed a new committee this year, AI in ICAI, to harness the potential of artificial intelligence to empower the profession and strengthen the operations and infrastructure in order to optimize productivity and meet the demands of a digital-centric world. Fostering research and development for capacity building, ICAI will further strengthen its research studies in the areas of accounting, assurance, taxation, finance and business advisory services to provide conducive environment for research, development and innovation. Integrity, which forms the core of the institute, recognizing the highest ethical standards.
Ethics is quintessential to the profession to ensure trust and integrity in financial reporting, auditing, taxation and KOLKATA, chartered accountants in Bharat have the highest ethics quotient.
ICAI is extremely focused on adapting and upgrading the acumen and skills of the professionals in tune with the changing requirements in order to provide conducive environment for research and AG to skill and train accountants at grassroots level. T signifies transparency, reflecting ICAI's commitment towards fostering trust and accountability while enhancing the quality of assurance services offered by its members. ICAI's pioneering initiative of UDIN for verification have instilled trust and transparency in the financial and auditing realms.
ICAI ने यूडीएन यानी यूनिक डॉक्यूमेंट आइडेंटिफिकेशन नंबर शुरू किया गया।
Independence I guides unbiased actions in the financial landscape. ICAI, the largest accountancy body, founded on the bedrock of ethics, integrity and independence, propelling India towards becoming an economic powerhouse of the world by 2047. With Drishti, ICAI envisions a golden period for the profession, shaping the future with innovation, integrity and excellence.
EIRC, all the past president of DTPA, I know everybody by name, I don't want to name everybody, and the speaker, Himanshu ji and Bagaji, thank you very much, Jatin ji, and all the members of our fraternity, thank you very much, and good morning to all of you. In direct tax is concerned, and the most important they have focused the entire farmer and the women are going to save the economy of this country. They have outlined a vision, and that's why as far as financial service and the economical aspect they want to present a paper. And as far as direct tax regime is concerned, 11.7% tax GDP ratio, a ambitious target they have put in the budget. Last time it was 11.6 and before that it was 11.2. And if you see the direct tax to GDP ratio, it's a 6.6, earlier it was 6.4 and 6.1. And as far as that indirect tax to GDP ratio, although the indirect tax is rising, but the GDP to indirect tax is only 5%. So the focus area is how this direct tax collection can enhance the economical background of this country. Before 10 years, if you see the direct tax collection 10 years before, 62% of the direct tax was coming from the corporate sector and 38% was coming from the non-corporate sector. After 10 years, with so many efforts, demonetization, GST, insolvency and bankruptcy code, RERA, and so many statements of financial transactions, some of the nitty-gritty they have outlined, people were forced to pay the tax. Now they are saying, last year, before this budget, the full budget, before the interim budget, 16 lakh crore direct tax was collected. And out of this 16 lakh crore, the surprising figure is 50% is coming from corporates and 50% for non-corporates. So the 38% become 50% and 62% become 50%. This is the ratio of the tax collection in our country. Now, yesterday data they have given 7.28 crore return were filed by 31st of July. And more than 72% has opted for new tax regime. And the finance minister has outlined within 6 months a new income tax act is on the unveil. They want to simplify, they want to reduce all the exemptions, and that's why they are focusing on the new tax regime. So most of the persons who are in the old tax regime are going and leaving this regime gradually. So what is the role of the finance and tax professional and the chartered accountant as far as this taxation is concerned? Recently in the income Supreme Court, a tax audit issue came. And in the Supreme Court judge has narrated in the order, the chartered accountants are the gatekeeper of this economy. The robust taxation financial systems are in the domain of the chartered accountant and tax professional. So the chartered accountant has a larger role as far as economical growth of this country is concerned. And that's why I can perceive when our institute was formed in 1949, the most of the practitioners who started this institute were direct tax practitioners. And there was a time, 75 years before, when the job opportunity was not so much. The moment you qualify, you are starting your own practice. But gradually with the advent of the time and with the evolution of the new technology, the new area of the practice has come. And in this 4 lakh chartered accountant today we have, hardly 1,50,000 CR in practice. The newly qualified chartered accountants are not coming to the practice because better opportunities are available. They don't want to struggle for 2 to 3 years. They don't have the patience. And 10, 12, 15 lakh rupees they are getting and they are going for the job. So a country of a shape and size like India, where 1.4 billion people, more than 7% growth we have. India and the Indonesia, they are the only 2 countries we are growing more than 5% in this world. We have $4 trillion economy. In the capital market already we have crossed market capitalization $4 trillion. So this 1.5 lakh practicing chartered accountant, who has the responsibility to drive the economical aspect of this country. And more so, the 4 lakh chartered accountants we have, the participation of the women and the girls to this profession is increasing every day. You will be happy to know, today out of these 4 lakh CA, every third chartered accountant is a women chartered accountant. Out of this 9 lakh students we have, more than 43% are girl students pursuing chartered accountants. And that is also without any reservation. We don't have any reservation in our profession. And when this profession is so vast and the country is so huge, I can see a huge, already the chartered accountants in this country are contributing in the growth and the tax collection of this country. If you talk about the RERA or the IBC, the data the government has given in the budget, 1,000 cases has garnered more than 3 lakh crore rupees of recovery to the creditors. And out of 28,000 cases, they have recovered more than 10 lakh crore rupees of amount without going into the insolvency proceeding, without admitting the cases in the IBC. So this IBC, more than 55% IP are chartered accountants. If the country is recovering the amount, the contribution goes to the chartered accountant. If the insolvency and bankruptcy law, RERA and the GST making this informal economy to formal economy, the contribution goes to the chartered accountant. If the direct and indirect collection and the GST collections are coming, the chartered accountants are burning the midnight oil every day, and they are advising the clients how to file the return compliance and how to pay the tax. But having said that, last 75 years we have seen what is the role and the contribution of the chartered accountant. But the time is changing. The time is changing. The young population we have. India is the world's largest and youngest population in our country. The only problem we have right now is the skill set. Every young people want to be rich overnight. They don't want to work hard. They don't have the patience. The SEBI has released the data last week. The concept paper they have released. More than 48% of the intraday loss are being done by the young people below the age of 30. Below the age of 30, 48% intraday loss they are contributing, which means overnight they are working on the FNO intraday and they want to be overnight. So this is the skill area which everybody is concerned, and that's why the focus of this government is how to reskill and upskill the young mass of this country. 20% populations are always bright by birth, by upbringing and by education. But I am talking about the 80% masses, 1.4 billion people. If the majority of the masses are not skilled and if they are not employed, there will be a social unrest. So it is the responsibility of each one of us, including the Institute of Chartered Accountants of India. Hopefully and thankfully, the Institute just now given the results of the CA final examination. First time 20,446 newly qualified has been become chartered accountant. This is the record so far. So the result of this final is 19.88%. The result of the intermediate is 19%, but the result of the foundation is less than 15%. Which means the young people, they are going to skill set. They are not passing the examination like Institute of Chartered Accountants of India. Having said that, those who are passing, they have enrolled earlier, 5, 7, 10 years before. Now they are becoming chartered accountants. So our focus is now how to give the skill set to the young people. And fortunately, whomsoever qualifies from the Institute of Chartered Accountants of India, the moment they qualify, they are employed in the ecosystem of the financial sector. So our focus is also how to reskill and upskill this entire 9.8 lakh students and 4 lakh practicing and non-practicing chartered accountants. As far as professional opportunity is concerned, let me tell you, in the Gandhinagar gift city, the government has notified financial service. Now financial service means bookkeeping, accounting, taxation and compliance of the financial fraud. Now if you are doing these services in the gift city Gandhinagar and the work has been procured from outside India being executed in gift city, you are getting 10-year income tax exemption. They are also giving exemptions as per RBI regulation is concerned. Income tax, SEBI and the other regulatory authority has given so much of exemptions. So we are thinking, we have a huge discussion with the government also. When India has a young population, there are 182 accounting bodies in this world where they have aging population. Nobody wants to be the chartered accountant in those countries. And in our country, 8,38,000 students enrolled for the foundation examination last year. That is the highest so far. So when we have a huge young population and when we can skill and reskill in the ecosystem we operate at the ICI, this country has the potential to become, if we can become the global leader in software export, pharmaceutical industry, this country has the potential to become a global hub of accounting and auditing is concerned, and we can cater to the entire world as far as accounting and auditing is concerned. That kind of capacity and capability we have. So on these lines, we are skilling and reskilling our students and the members. Recently, as far as this artificial intelligence is concerned, now the way you have done the practice in last 75 years, this practice will not survive. A to do the physical stock taking of the big assets like large trucks or a wind power machine. Now people are taking help of the drones to do the physical verification of the assets. Artificial intelligence, they are using just to know the credential of the client before accepting the audit assignment. Just to finalize the audit team, how the quality of the audit team should do the conduct the audit, they are using the technology of artificial intelligence. Non-compliance or compliance of the various laws and regulations, whether the entity has done or not, before finalizing the audit report, they are using the technology of artificial intelligence. So without artificial intelligence technology, the audit and the accounting profession which we operate right now will be difficult to progress. And that's why our focus this year had been how the 9 lakh students and 4 lakh members should be upskilled as far as artificial intelligence is concerned. And that's why on the 1st of July, when our Honorable Minister Nitin Gadkari, he was the chief guest, our 75th celebration in Bharat Mandapam, we have launched ICI GPT for our members. Now there are 7,000 listed company and 70 lakh unlisted company. Now you, while reporting a related party qualification or related party transaction or a caro reporting or a stock taking, you want to know 7,000 listed company auditor what reporting they have done. You want to draw the reference. Now we have downloaded all these 7,000 reports in the GPT. What are the qualifications? What are the audit fees? What are the notes on accounts? What are the adverse comment? All these things, now if you want to know, by click of the mouse in your mobile phone, you can know in the fraction of the second. And this GPT tool, we have given the 4 lakh chartered accountant free of cost. On 16th of July in Hyderabad, in a summit of AI summit, all the stuff of the students, study mate, suggested answer, RTP, question bank, we have downloaded in the GPT system. A student wants to know what is AS1 and why this AS2 talks about cost or NRV, whichever is lower. The GPT will answer you by fraction of second. Entire study mate, suggested answer, RTP are in the GPT system of this ICI GPT, and we have given on 16th of July these 9 lakh students this system free of cost. So without artificial intelligence, without the help of the technology, it is very difficult to progress the way the country wants or expects from us. For us, AI means not artificial intelligence. AI means accounting with innovation or auditing with innovation. That is the word we have coined for ourselves. Now comes to the non-financial reporting. You have seen the RBI consultation paper. Now the RBI consultation paper talks about which industry to give what kind of credit. If the industry is polluting more or more carbon emission, what kind of credit should be given? Or those industries which are less carbon emission, what kind of credit should be given? What should be the rate of interest? These are the suggestions they are seeking from the public at large. Now the non-financial reporting as well as financial reporting will be the part of the audit report in the days to come. Already the SEBI has made 1,000 top listed company BRSR standards mandatory. This will percolate down to other listed and unlisted company in the times to come. So we as a chartered accountant, whether we can confine ourselves to tax, audit, compliance, or we have to inculcate in our thought, mind and training and knowledge the reporting requirement of non-financial reporting. IFRS Foundation talks about S1 and S2. They are more stringent. We have not adopted that so far, but the time is coming. 1,50,000 practicing chartered accountants. If we are not conducive or inculcating these kind of development in our reporting will not be that effective which the government is expecting. And that's why there is a section called 143(12) fraud reporting. 1 crore and above you have to report to the government whenever fraud is there. We have approached the city. Whenever 143(12) happens and it is detected the fraud is being done in the company, when you want to re-audit that company, that should be done by a forensic auditor. And that forensic auditor mandatorily should be the member of the Institute of Chartered Accountants of India, so that we can take the disciplinary action if something goes wrong. Today, forensic auditor can be done by anybody. How to catch hold of them? So as far as the regulatory requirement is concerned, we are also giving our thoughts to the regulator. But at the same time, 1,50,000 practicing CA, they have to be very vigilant, very tax savvy, and very, very mindful what you are signing and why you are signing. Last 75 years, we are the only professional who has this mandate what to certify true and fair and true and correct. No other professional in this country has such a huge power which we have. So the expectation is bound to rise. So we have to change with the changing time, and that's why audit profession and the consulting profession and the other profession like advisory is going to be more lucrative provided skilled professionals are there in that regime. Just getting degree and passing and just signing will not work anymore. We are also thinking as an issue. Next month the agenda is coming in the council. You have qualified as a chartered accountant. The moment you qualify, you want to get the certificate of practice. There are many countries in the world. They will not renew your certificate of practice if you don't go for a small examination. Whether you know the code of ethics or accounting and auditing, without going for the examination, they don't renew that COP. But we are not going to that extent. We are saying, once you qualify and you want to go for COP, before getting COP, the institute will conduct 10 days residential certificate course in Center of Excellence across the country. Once you attend the 10 days certificate course, only then certificate of practice will be given to the newly qualified chartered accountant. That kind of thought process also we are inculcating. So my point here is, in this next seminar, chartered accountants are the growth engine of the economy as told by many politicians, bureaucrats and the regulator. But now, drawing the reference from these political leaders and the regulator, we also have to live up to the expectation of the entire ecosystem. Only then we will be considered as a partner in nation building. And rightly said by recently the Om Birla, the Honorable Speaker of the Lok Sabha, the country will be a developed country in 2047, no doubt about it, the kind of capability we have. But the most and the major contribution in the development process as a developed country in India will be by one professional, and that professional or profession is the profession of chartered accountants. So I can see a great future. We all are a very matured and well thought, the kind of degree we are giving as a chartered accountant. We are a finest professional in this country, provided we can change with the changing time, update with the changing time, and we can draw the reference from all the regulator how we can be a best professional of this country. I can see a very glorious past we have last 75 years. At the same time, a very inspiring future I can see for next 25 years for our professor. Thank you very much.
Thank you, Ranjit ji. Every year, a souvenir is released on the occasion of the annual conference. The souvenir contains articles on various topics, that is income tax, GST, technology, to name a few. I would now request our chief guest, C. Ranjit Kumar Agarwal, President, Institute of Chartered Accountants of India, to kindly release the souvenir. I request C. A. Girdhar Deliaji, Chairman, Souvenir Subcommittee, C. A. Sujit Sultania, and C. Ankit Botra, Co-Chairman, Souvenir Subcommittee, to join the dignitaries on the dais. Thank you. For the last 3 years, DTPA is releasing a publication, Selected Income Tax Issues and Insights, under the chairmanship of CAPR Kothari. This year we will be releasing volume 4 of the same publication. Number of relevant issues are selected and analyzed by the various authors and compiled in this publication. I request as chief guest C. Ranjit Kumar Agarwal to kindly release the publication. I also request CAPR Kothari, Chairman Direct Tax Research and Publication Subcommittee, and Co-Chairman Sanjay Bajoria and C. Ajit Kumar Tulsian to join the dignitaries on the dais. Thank you, sir. I request our Secretary C. Mahindra Agarwal ji to offer a vote of thanks. I also request the delegates not to leave the hall since we shall be commencing the first technical session immediately.
Good morning, Suprabhat to all. Thank you is such a prayer that cannot be seen or touched. It must be felt by the heart. I feel honored and privileged to get an opportunity for expressing the same. I express my gratitude and sincere thanks to our chief guest, C. A. Ranjit Agarwal, President ICA, for his valuable insights and word of wisdom, and for sparing his valuable time for our annual conference. Thank you, sir. I thank all the speakers who have come from various parts of the country for taking time out of their busy schedule. I also thank Chairman Direct Tax Publication Committee, CAPR Kothari and his team for publishing the 4th edition of Direct Tax Publication. I also thank Advocate Ankit Kanodia, Chairman GST Research and Publication, and it is from publication of his 4th edition of GST books. I also thank Chairman Souvenir Committee, C. A. Girdhar Deliaji, and Chairman Director Committee, C. A. Sujit Sultania, and our Master of Ceremony, C. A. Ritesh Miller. I also like to thank Chairman, Co-Chairman of the Conference, President DTPA, all the past President of DTPA, Office Bearer, all the members attending the conference, and our sponsor for their support and the efforts in making this annual conference of DTPA a grand success. Thank you, sir. Thank you.
will be starting the first technical session immediately. The first technical session has two speakers, CA Dr. Girish Ahuja and CA Jatin Christopher. Due to his preoccupation with the budget discussion, CA Dr. Girish Ahuja could not join us physically, but will be joining us virtually. He has already joined us virtually and is available on Zoom. I welcome both our speakers for the session. I request CA Rajesh Agarwal, President, DTPA, CA NK Goyal and CA TS Agarwal, Chairman and Co-Chairman of the Conference Committee, to kindly escort CA Jatin Christopher to the dais. Also request CA Manjulata Shukla, Vice President, DTPA, CA Shyam Agarwal, Joint Secretary, DTPA, to come to the dais. The first technical session has been split up in two parts, direct tax and indirect tax. CA Dr. Girish Ahuja will share his thoughts on deemed income vis-a-vis real taxes, the dynamics of modern taxation. Our indirect tax expert, CA Jatin Christopher, will share his thoughts on deemed supply and valuation, a Pandora's box. We request everybody to settle down because our speakers have joined us and we would like to start immediately. Kindly take your seats, please. CA Dr. Girish Ahuja is a distinguished figure in finance and accounts. Apart from being a fellow member of the Institute of Chartered Accountants of India, he has earned a PhD from the Faculty of Management Studies, FMS, Delhi University. He has been teaching direct taxes to students at various levels for more than 35 years and has been a senior faculty member of the Sri Ram College of Commerce, Delhi University, and a visiting faculty member of the Institute of Chartered Accountants of India, Institute of Company Secretaries of India, and various other management institutes. The Indian government has recognized his expertise by appointing him to significant roles. He served on the task force for redrafting the Income Tax Act and the new Income Tax Law, which is underway. Dr. Ahuja is also a prolific author on direct taxation, contributing significantly to the field's literature. We request all of us to kindly welcome Dr. Ahuja with a big round of applause, please. CA Jatin Christopher, qualified in 1996, is a chartered accountant, cost accountant, law graduate and specializes in indirect tax laws. He is a published author and a resource person for the Institute of Chartered Accountants of India in its various post-qualification programs on indirect tax and extends support to ICAI in publication of education and research material on various indirect tax topics. He is also a resource person on the government in conducting training for practitioners, trade and officers. He has been in practice since 2000 as a partner in JCSS, a full service firm with presence across India. We request you to kindly welcome CA Jatin Christopher. I request CA Agod Dudewala, past President DTPA, to come forward and present a shawl to CA Jatin Christopher. I request CA Sunil Surana to kindly come forward and present a memento to CA Jatin Christopher. Thank you, sir. I now request CA Dr. Girish Ahuja to deliver his address on the topic deemed income vis-a-vis real taxes, the dynamics of modern taxation. Over to you, sir.
Thank you. Very good morning to all. And with folded hands, I seek apology from all of you. I had some very important engagement in Delhi, so I requested, and particularly Rajesh ji, I seek your apology for not coming personally there. Of course, sitting on the dais and of course other places also. Rajesh Agarwal is not there because he's already left. President of the DTPA, Sri Rajesh Kumar Agarwal ji, Chairman of the DTPA, Sri Narendra Kumar Goyal ji, IPP, immediate past President and Co-Chairman, CA DS Agarwal ji, Senior Vice President, CA Bhatta Agarwal ji, CA Manju Lata, VP Vice President, of course, CA Mahendra Agarwal ji, General Secretary of the program, General Secretary of the DTPA, CA Shyam Agarwal ji, Joint Secretary, CA Girdhar Dalia ji, Treasurer of the event, and the fellow speaker sitting on the dais, of course, CA Jatin Christopher ji, ladies and gentlemen. Well, friend, it is my fault, of course, but Rajesh Agarwal ji informed me that if at all you cannot make it, please make it on the online also. So let me tell you one thing very clearly. We have section 2 clause 24, which talks about definition of income, and it is an inclusive definition. So many items have been included in the definition of that is inclusive definition, which does not appear to be the income. Like capital receipts are all there now in the income, like voluntary contribution or by the received by the charitable trust, like capital gain. There are like so many other items are dividend. Everything has been included wherever possible. 56 to 10, 52 7A, 57B. They are all included in the inclusive definition of income. But in addition to that, there are certain income which have been treated as deemed income. They are in reality, they cannot be called income. And you have not received that. But still, the law says we will treat it or deem it to be income taxable in your hand. And the best example of that, of course, is section 2 clause 22 subclause E. What does it say? Where a closely held company gives any advance or loan to a shareholder who has 20% voting power in the company, or to a concern in which such shareholder has 20% voting power. In that case, the amount so paid will be, although it is low, although it is advance, which cannot be called income, but still they say this is deemed to be income in your hand to the extent of the accumulated profit exclusive of capitalized profit. There. So the other deemed income also, section 2 clause 22A, 2 clause 22B, 2 clause 22C, 2 clause 22D. But this specific is doesn't appear to be. I have given loan, I have given advance, and to whom? To a person who has 10% voting power, a shareholder, fine shareholder, closely held company, or to a concern in which that person has over 20% voting power, 10% or 20%, it is called deemed taxable in the hands of the recipient. So why this has been done, you all know. I need not mention. There are certain cases where if this advance has been given for business purposes, they have not treated as a deemed dividend. But in all other cases, instead of giving dividend, you are trying to give loan and advance to a shareholder who is holding 10% voting power, so that payable when able, but at least you are saving on dividend tax. So they have already said, please note this is deemed dividend unless those conditions, or unless there are certain judgments which are there, you satisfy those. Coming to the next one, 23.4, house property. Earlier you used to have more than one house property for self-occupation. They used to say one house property out of that shall be treated as self-occupied, others property shall be deemed to be let out. But now you can hold two house properties for your self-occupation. One where you are living, another maybe you are having in your village or maybe in your other place or part of the country. You can hold two house property, self-occupied. But if you have more than two house properties self-occupied, and you have not let them out, that says the income should be treated as deemed to be let out, and you will have to tax under section 23. Deemed to be let out, although you have not earned any income, still you are liable to be taxed on a property which is kept vacant and which you have more than two self-occupied property. So that of course is another very important. Section 23(5). You are holding a land or building as stock in trade. Particularly, you are holding a house property as stock in trade. Maybe it is a residential house property, maybe it is a commercial house. And you are not able to let it down. It is a stock in trade, you are not able to let it down. The law says for the first 2 years after getting the completion certificate, this will not be taxable. But if you have kept it beyond 2 years, then it will be deemed to be let out. And even if it is a cost of stock in trade, even if it is a stock in trade, you will have to pay tax under the head house property. 2 years after the completion certificate, for the end of the year, when the completion certificate is issued to you, we have no issue. After the end of the previous year in which commission is issued to you, we have no issue. It is not an account, no problem. But the moment you cross 2 years and it is not let out, we will treat it as deemed to be let out under section 23, subsection 5. And in the recent explanation, please remember, recent explanation given, the explanation 3 and 28 in the budget, saying that if there is a residential house or part of the house which is let out, the income derived from that property shall be deemed to be taxable under the income from house property. Meaning thereby, you will not get deduction under Chennai Property Judgment Supreme Court, where you are in the business of letting out of properties. You could claim it as a deduction, all deductions under section 28. Now they have said, look here, if it is a residential property or a part of the residential property which is let out and you are deriving income from that property, it will be deemed to be an income taxable under the income from a house property, meaning thereby only 30% standard deduction will be allowed, no other deduction except of course interest on money borrowed will be allowed to you. Because Chennai Property had given the judgment, if there is a property, which is let out. I'm getting some noise from there. So this is also very important point, 28(6)(a). You know, we have section 45(2) which says conversion of capital asset into stock in trade is a trust. It is a trust. But the capital gain arises in the previous year in which such converted asset is sold or otherwise transferred. But wonderful thing, now 28(6)(a) saying that if you have converted a stock in trade into a capital asset, just conversion, just treatment of stock in trade as a capital asset, where is the income? Just treat it. Earlier it was a stock in trade, now I'm going to treat it as a capital asset. Say, look here, fair market value of that house property which has been converted, or that land which has been converted into capital asset shall be taxable under the income from income from business and profession, profit or gain from business and profession. Suppose there is a builder who is constructing commercial property or residential property. Now he says, let me have 2 floors for my own office. That commercial property was his stock in trade. Now he is trying to treat it as a capital asset for opening or starting his office. The law says, whatever is the fair market value of that property on the date of conversion shall be liable to be taxed under the head profit or gain from business and profession. I take an example. Suppose there is a commercial property whose stamp duty value is 20 crore, let's say 10 crore. You have converted that stock in trade into capitals. Please note, entire 10 crore will become profit or gain from business and profession. Please note, entire 10 crore. You will say, what about that cost of that house property? Please note, it is a stock in trade. The closing stock will automatically come down by 10 crore and the profit will be adjusted. It's a part of the closing stock and it has not been sold. Now, closing stock has been treated as a capital asset, that whatever the cost of that closing stock, let's say 2 crore was there, now it is 10 crore. That 2 crore stock, already closing stock value will come down, automatically profit will come down by 2 crore. But in your case, the entire 10 crore will be treated as profit or gain from business and operation. This is also a very surprising that you have not done anything, you have converted, like Reliance share. You have a Reliance share, which you have bought for 500 rupees today, it is 3,000 rupees. And you convert, you are in the stock entry. Reliance was in the stock entry. Now you are converting this Reliance share into a capital asset. The entire 3,100 rupees will be taxable at business income, and whatever 500 you have purchased will be reduced from your closing stock, and automatically that will be adjusted. So this is a real surprise that you have not done anything except that converted into that they are treating as part of the business income up to the date of conversion. Next point. We already have 43CA, we already have 50C, we already have what you call 50CA and 50D. 43CA is what? There is a house property which is part of stock in trade. You want to transfer that house property. The consideration price shall be deemed to be the stamp duty. You are not able to sell it for consideration, stamp duty value. The loss is nothing. We will charge tax as business income based on the stamp duty value, minimum stamp duty value of that house property which you are transferring as part of stock in trade to others. You are selling the house property. What we will get? Stamp duty. The margin that safe harbor rule or safe harbor is 10%, which you know that. Otherwise, they say, please you have to sell it at stamp duty value. Otherwise, you will be liable to pay tax as business income on the difference also. Similarly, 50C, where the consideration accruing from the transfer of a capital asset, be land or building, is less than the stamp duty value fixed by the stamp duty authority for the purpose of computing capital gain, the consideration price shall be deemed to be the fair market. Deemed to be the market value, consideration price shall be deemed to be. Meaning thereby, if you are transferring any capital asset, be land or building, everyone knows you have to transfer at minimum stamp duty. Beyond that, these days everybody will try to sell it beyond stamp duty value because you will be able to convert your money at 12.5%. Because now that there has been a reduction in the capital gain from 20% to 12.5%, who will not be interested to sell the property at a higher price? It more than stamp duty value, because you are able to get the white, black, nobody is interested in that money these days. You are able to get the entire amount as white money, and you have to pay tax only at the rate of 12.5%. Of course, without indexation, everybody knows, because now this budget has been there for 2013. 56. Now my income. I buy a property from you. It is a capital asset. I buy a property at less than stamp duty value. I have paid the stamp duty value is, let's say, 2 crore. I have given you one. I have bought it for 1.5 crore. 50C says, look here, the difference between the 2 crore and 150 crore, we will have to charge the price at 2 crore, we will charge next one. In my case, if I bought it for 1.50, stamp duty value is 2 crore. The difference, this is inadequate consideration. The difference between the stamp duty value and the value at which I have purchased, 50 lakh, will become taxable in my hand under the income from other sources. Rather, he is going to pay tax under long-term capital gain or without, let's say, without indexation or with indexation earlier year, he has to pay tax maybe 20% or 10%, but I will have to pay tax if I buy a property for a price less than the stamp duty value at 30%, means I have income under their other sources. This is what is there. Yes, safe harbor is there, that maximum difference can be 10% of the actual consideration. Beyond that, if it is there, please note 56 to 10 will come into picture and you will have a lot of difficulties. You will have a lot of difficulties, everybody knows. So I have done 53CA, 50C, already all you know, or 56 to 10. But coming back, there is a present system of presumptive income also under 44AD, 44ADA, 44AE. What is that? It is also a deemed income. You don't want to maintain books of account, we will not force you. If you show your income under 44AD at the rate of 8% or 6%, as the case may be. 8% if it is not of the account paid check or account paid draft or any electronic board, 6% of the turnover if it is in electronic board or an account paid check, etc. You have to show minimum 6 or 8%. Please note, it is minimum 6 or 8. If you are earning more than that, kindly note, you have to show higher income. You can't say, I have earned 6%, I am paying tax on 6% and earning the income 40%. Question does not arise. If it is higher, you have to take higher. If it is lower, it is for the benefit of the revenue and not for your benefit. Because your income is lower than 8 or lower than 6%. In that case, you have to show your income to be 8 or 6%. Otherwise, you will have to maintain books of accounts and get them audited. So there is a deemed income if you want to show without maintenance of books of account and whether audit. It is a presumptive income, like where 44AD professionals also, you have to show a minimum profit of 50% of the gross. 50% income of the gross receipt you have to show as your income. If you want to show less than 50%, mind it, you will have to maintain books of account and get them audited. So the law has assumed this is for the benefit of revenue, that if you are earning less than 5, please, less than 50, please show 50. Otherwise, you will have to maintain books of account and get them audited. And if it is more than 50, you have to show more than 50. You cannot say, sir, I have earned, you are giving 50%, but I am earning 80%. You cannot do it because you are not maintaining books of account, agreed. But there is, passbook is not a books of account. Bank account is not a books of account. And if the money is lying in the bank or passbook, or obviously in the bank, they will say, what is the source of this money? And we have 69 sections saying unexplained investment. We have 69 also. You say only we have to give only 4 items in the case of 44AD. You have to give opening debtors, creditors, cash balance, stock in trade. How would they come to? That you have not to say. How would they come to? These days, they have more information about you than you have about yourself. They are getting complete information. You know that annual information statement, what is coming in the annual information statement, not a single penny you can hide. There are certain exchange of information from 126 countries coming to this country from other countries. So please be careful. If it is more than 8 or 6, you have to show more than 8 or 6. And if it is more than 50, you have to show more than 50. You cannot say it is only 50. So that also a presumptive is also a deep. Like recently they have introduced cruise shipping. And we have given a benefit to the new resident. Please pay tax at the rate of 20% of the gross receipt. And we will allow you 20% of the gross receipt. And simultaneously, the release rental under section 1015B has been given exemption. So my point is, the law is very clear. They want you to show all income, and you all know that the rate of section 68, 69, 69A, 69B, 69C, and 69D. In all these cases of 69D, 68, 69, let me tell you, now there is no question of hiding. What does section 68 say? where any sum is found credited in the books of accounts of the assessee. Please note the word found credited in the books. Sum found credited, and I said income found credited. Sum found credited in the books of account. It can be gift, it can be sale, it can be any loan. A sum is found credited in the books of account. And the assessee does not offer any explanation, the nature and the source of that fund, or offers an explanation which the opinion of the AO is not satisfactory, then he may tax this sum under section 68. This is deemed income. 68. Even loan can be treated as income. Even gift can be treated as income. If you are not able to give the nature and source of that, if you are given the explanation and it is not found satisfactory, the gift, please note the case of a gift. Now, gift to relative is exempt. Note 56 to 10. Exempt. Because you will have to give the source of that gift. 56 to 10, you might have said it is exempt. Give me the source of that gift. If it is not genuine, you will be liable to pay tax under section 56 to 10. You will say it is not recorded in the books of account. Even if it is not recorded in the books of account, section 69 will come into picture. Unexplained investment. Where has this money gone? Where it is in the bank or wherever you have invested. So be careful. Even if there is a gift, you have to give the source of the gift. And if it is gift to non-relative, obviously, if that is credited in the books of account, you have to give the source of that gift. It should be genuine. And if it is not credited in the books of account, 69 will come into picture. Now people are saying me, sir, section 56 to 10 says that there will be gift of more than 50,000. Then there is a gift of movable property or immovable property, gift of movable property, and movable property means capital asset being shares and securities, being jewelry, archaeological collection, drawings, paintings, sculpture, work of art, or bullion. Sir, I can take a gift of motor car because motor car is not there. Certainly you can take a gift of motor car even if you are not a relative. But you will have to give the source of that gift. You will have to give the source who has given you that car, and if you are not able to prove the genuine source, liable to tax it. And in 68 section, you have already some problem. That problem is if you borrow any loan, if you take any loan or advance, which is recorded in the books of account. 68 is only when recorded in the books of account. You don't only have to say the source, you will have to give the source of that, source of that loan. Source of the source of that loan. And similarly, if you receive any application money, you receive any share premium, you receive any share capital, not only the source who has given you that, but also the source of the source will have to be proved. Otherwise, section 68 will be a threat. I remember when this demonetization came to Mr. Getty, that point I told you the point. At the rate of 200, apparently at the rate of 200%, under 278, because of you are not, it is not your USA reporting of you. You will be liable to pay penalty in economics. I went to him. He said, how can there be penalty? There is no section which can there be penalty for the demonetization if that money has been deposited by me and shown it as income. I have already shown it as income. How can you charge charge penalty on me? He said, I don't know. I'll have to check up with the revenue secretary. Revenue secretary came and then CBD chairman came and then the person who had drafted the law came. I said, look here, you cannot charge it. He said, we will charge it under 68. I said, you cannot do it because 68 is, if it is found by the AO that I don't know the very source. But if I have already reflected in the return of income, I am saying whatever demonetization or money I have, I am showing that my income of the current year. How can you charge me the penalty? You can charge me tax at the rate of 30% plus surcharge, etc. Then they have to change the law. Remember, 115 BBE came from 1st of April 2016, whereas the demonetization was on 8/8/2016, stating that where the total income includes section 68, 69, 69A, 69B, 69C or 69D, and such amount is reflected in the return of income. Please You are showing in the return of income as this, but you do not give the nature and source of the income, then the entire amount will become taxable at the rate of 60% plus surcharge 25% plus education tax at that time was 3%. This was 115 BBE. Mind it, even if you have shown as income now in your return, you have to give the source of that income. Otherwise, 68, 69, 69A, 69B, 69C, any of that can be made applicable and you will have to pay tax at 78% now. And second point was, if it is not shown by you, but it is determined by the AN, then in addition to the 78% tax, you will have to pay some, what you call penalty at the rate of 10% or 60%, that is 6%, 84%. And at that time, even the search was taxable at 78% plus 30% penalty if you have declared that. And if you have not declared or surrendered that income, it was 138%. Thanks to the government, they have agreed to one thing, that now such cases will be for 6-year block assessment and you will have to pay tax not at the rate of 108% or 130%, at the rate of 16%, without any interest, without any penalty of 278, whether interest at 234A, 234BC, but mind it, you must file the undisclosed income in the return when they are asking to file the return. And if you do not surrender that, you will have to pay penalty also 30%. That means 60, 50%, 30. So now maximum is 90% here, or 60 as the case may be. But what I am trying to explain, 68 is also a deemed case. 69, unexplained investment. Now there is an investment you have made, you have purchased a car, you have purchased a house property, you have this, and you are not able to give the nature and source from this money has come. This money has come, you have to give, you have purchased gold. And what is the source of this? If you are not able to give, even if it is not recorded in the books of account, you are not able to give the source of that, 69 will become taxable, applicable, and you will have to go for 78% in that case. 69A, money, bullion, jewelry, valuable article or thing are found in your possession and you are not able to give the nature and source of that, then the entire amount, the very market value of that asset shall be deemed to be your income of the previous year in which it is found. My point is 69A also will attract 150 BBE. It is a deemed income. 69B, investment not fully disclosed. And you have recorded in the books account, the property constructed by recorded in the books account for 5 crore. According to them, the cost of construction or everything including land, the price is 7 crore. Investment not fully disclosed, the balance 2 crore will be deemed to be your income. And you will have to pay tax under section 115 BBE. Similarly, unexplained expenditure. There is expenditure which have been recorded in the books of account and you are not able to give the source and nature the source of that expenditure. The whole amount will be treated as your deemed income. And you will not be allowed deduction of that expenditure also. This is one another thing. So 69D, borrowed on hundi or repaid on day without account paid check. Again, you are liable for penalty. And that this is what is 115 BBE and this is what are deemed income. Borrowing a loan, borrowing on hundi, making a payment not in account paid check, they say this is your income. This is your income liable to be taxed. So these are deemed type. Another deemed type of income. I would not like to know, everybody knows, clubbing of income. It is not my income, but still it is included in your income because of gift to the spouse or gift to the son's wife or income of a minor child or transfer of an asset or inadequate consideration to what you call to the spouse or to the son's wife. They are all treated as a deemed income. Clubbing of income will be part of your income, although it does not belong to you. A transfer to a revocable trust. If you have transferred an asset to the revocable trust, income will be added in your income. If there is a transfer without transferring the asset, that also is covered under section 16 and taxable in your hand. So don't think that although they have given many provisions, but at the same time, they've already said to you, there are certain income which you might not have received, but it will be treated as deemed income in your hand. If they are able to, I have given all those sections. 150 TD charitable trust. If there is a charitable trust claiming exemption under 11, 12, 13 or 10, 23C, and if that charitable trust merges with any other charitable trust which is not registered, or if charitable trust goes for any activity where you are not liable to be registered, or you are not gone for your re-registration or renewal of your registration, or you have not gone for registration, accreted income 115 TD, fair market value of all the assets minus the liability on the date of this conversion will be deemed to be your income taxable under 150 TD. This is very important for charitable trust. They say you have been claiming exemption. Now you have created asset with that exemption. And if your exemption is cancelled, or you don't go for renewal, or you merge with it which is not eligible, mind it, the entire fair market value of the asset on that particular date minus the liability shall be taxable at 30%. Even for anonymous donation, they have said that if you have received any anonymous donation, and please, if you have received any donation, kindly give me the name, address, and PAN number of that person who has given you the donation. But if you are not able to give the name, address, PAN number of that person, we will call it as an anonymous donation. And the anonymous donation shall be deemed to be income more than if you have received more than 5% of the total donation, or what do you call it? 1 lakh, whichever is more. And you will be liable to pay tax on that income at the rate of 30%. That you have to be careful. And in the case of self-generating asset, they said the deemed cost will be taken as nil. The law is very clear that please note, you have to pay tax if it is the goodwill of a business, goodwill of a profession, a brand name, trade name, any right, any license, any franchise, where it is self-generated, brand name self-generated, goodwill self-generated. They say deemed cost shall be nil, and you will have to pay tax on the fair market value minus the cost as your capital gain. Another point which I would like to say, my point is, the law has been made very clear. They said whatever we have given in 224, that of course is already an income because it is an inclusive definition. Whatever we have not given in 24, but can still be treated as deemed income and taxable in your hand. Particularly at times, it may be taxable at a higher rate, or it may be taxable less. So our law has made it a point, even today, this budget, buyback of share was taxable in the hands of the company at the rate of 20% plus 12% plus 4%. But now they said it will be treated as deemed dividend. Whatever amount you receive from the company on buyback of share, the entire amount shall be treated as dividend and liable to be taxed under the income from other sources. You will not get any deduction of whatsoever nature. They said, sir, what about my cost? I have purchased let's say, Pidilite share for 500 rupees. Today it is for 3,000 rupees. You said, if the company buy back that share at 3,000 rupees, entire 3,000 will become taxable in your hand. Entire 3,000 under section 2, clause 22, sub clause F as deemed dividend. Sir, what about my 500 rupees which I have? He said, don't worry. We have a 46A section, and they say consideration shall be deemed to be nil. If this is extinguishment of your share, and the consideration shall be deemed to be nil, meaning thereby 0 minus consideration is 0 minus 500 rupees shall be treated as a capital loss, long or short depends on you, and that will be taxable. That loss will get allowed to be set up from another capital loss as per the rules, as per the provisions, and if you are not able to set up, you can carry forward. The purpose has been done. Now you will remember 156(2)(7)(b) also has been abolished. Now you can issue the share at any value, no question of setting it at fair market value, The rule 11 U82 is also wrong. I'm only, sorry, on online it is, therefore I seek your permission to close my discussion on this, or if you have any issue, you can please ask me, otherwise I give it to the, what you call, organizer to take the proceeding further.
Good afternoon, sir. Sir, we have posted some questions on WhatsApp as received.
One minute. Let me see.
I'll ask one by one, or you can
Why
ask.
are deep provision inserted? Why are deep provision inserted is only because of the fact that we cannot visualize all types of income included. They said we will treat this as income if there is an intention. Why are we saying you are not letting off the property? Now you are not letting off the house property. You are keeping more than 2 house properties. Why should we allow you an investment where we are not getting any revenue of that? Rather than you pay, when you transfer, you will pay capital gain tax, that too now at 12.5%. We want you to let out the property and show us the income, otherwise we will treat it as a deemed let out. So there are many provisions like this. Even this deemed income under 68, 69 or 50C, you could transfer it to a lower price. They said nothing doing. Consideration price will be stamp duty value, so that you will have to pay tax on the difference if you are not able to sell. The purpose is you should show your income in original income and not should not go for blackmail. So many sections have been brought only for checking the loopholes in the law or your avoidance of the tax. They said no, you have to show your real income. Maybe it is not received by you. Maybe it is not received. They have no other alternative. They have no other alternative in the house property. In the case of immovable property, things have been changing for ages. Sometimes they said this will be treated as competent authority can acquire this can happen. Now they have settled that you have to sell at the stamp duty value. Less than stamp duty value, we will not accept it. So this is a dream. Letting out deemed income. Even dividend is a deemed income because you have given a loan in advance. Because you are trying to dodge the law. You are trying to give the lower advance and instead of dividend to your shareholder. Buyback is also one for you. Why? Because buyback the 20% was there, now it is deemed dividend, it is 30%. So they know that people were going for arbitrage. They were making repurchase of share, buyback of share and avoiding tax to the extent of 8 to 9%. So that's why it has been done. And the second point is scope of deed provision. I have told you. Is there any white paper made before such provision to justify it? Such white paper is not. The information is coming from various commissionerate in what kind of things are happening in what people are doing, and that's why they have to. People are going for innovations, and those innovations like transfer pricing. There also they have said. If you are dealing with your associated price, you should do it at arm's length price. You cannot claim more deduction. Why? Because this is also deemed. Arm's length price will have to work out if you are working for associated price. Because India should not lose its revenue. If you are making a sale at a lesser than the market value, you are losing. If you are borrowing money from there at a higher rate of interest, you are losing. Why should India lose? Now they are concerned with the deemed resident concept also. When you are not liable to pay tax all outside India, you are not liable to pay. They said you will be deemed resident of India if you happen to be a citizen of India. So those things are coming from there. Whether deemed provision overrides, certainly. Wherever it is there, it is overriding that you are not showing, or they are putting condition on. If not overriding, they are putting condition on that. Or the benchmark, the value, online price, different method given, or value appropriate for administrating team, you should know yourself. Because already we know that information is coming from all parts of the country as well as 360-degree profile is there. They want you to show your real income. And if you are trying to go for not real income, they will introduce deemed provision to club that loophole and tax you that. What has been the success of these tax provisions? You yourself know. Why should you ask me whether there has been a success or not? But people keep on looking for new innovations to avoid tax. But let me assure you, we have worked very hard to pass chartered accountancy examination. We are not meant for such things. We should pay tax and enjoy life. Now you only have to pay income tax. You don't have to pay wealth tax. You don't have to pay gift tax. You don't have to pay inheritance tax. And still we want to save tax. I fail to understand why should we do that. Please pay tax, in an honest manner. Enjoy the life. Don't go for black money. Black money has no value. Either you get spoiled or your children get spoiled. I am very clear in this. Have these deemed provision increased litigation? To some extent, yes. They increase litigation also. I am not denying that fact. But there is no other way. There is no other way to tax that income. Yes, if the deemed litigations are there, you can only say, I have given the full explanation, I have given the nature and source, but AO is not satisfied. Those is the litigation which is coming up now. EO is not satisfied. Nothing. Government is interested in coming and you have been given Vivas Vishwas. Why they have given? Why you go for it? Dear company, if there is any case pending, please pay tax and enjoy life. Why are you doing it? We have done in 220. Now we are again brought with and even for such cases, even for reassessment, they have brought down 6 years to 5 years, and such cases block 6 years and rate of tax has come down. I don't think there should be any chance or you should go for such things. Are we heading towards pure redeemed origin? Not heading towards. Wherever it is not possible to plug that loophole, we come with the deemed. We do come with the deemed provision if we not possible. Sir, I am not from a department. Don't think that I am, but there are certain issues which are very important. Like, at one time the law was employer's contribution to recognized provident fund is exempt up to 12% of salary. The CEO, CFOs getting salary 2 crore, 3 crore, 4 crore a year. 12%, if they tell their employer, please contribute 12%. 12% of 3 crore is 36 lakh. At that time, that 36 was completely exempt, not exempt. Then the interest which you are getting on that 36 lakh was also exempt. And at the time when the payment is received back from, were also exempt. These were the benefit which you were getting for 1961. Unfortunately, I mentioned to them that this is happening. Then they said, no, we didn't know. Let us still do it. 12% of employer contribution. I told them, please make it up to 1 crore salary, 12 lakh. They did not agree. Then I said, okay, please bring down to 9 lakh. That too they did not agree. Now says, contribution by the employer to recognize provident fund will be exempt up to 12% of salary or 7,50,000, whichever is less. Whichever is less. Now maximum employer contribution 750. The game started from there. Now interest on employee contribution on this amount is also taxable. And if you employee contribute more than 2,50,000 in a year, the interest on the excess amount has become taxable in your hand. Now similar thing has happened with life insurance policy. You cannot take policy for more than 5 lakh and you cannot take unit for more than 250. So they are now trying to put restrictions for which you are taking as a benefit, like entire payment for provident fund exempt, entire life insurance premium exempt, entire unit was exempt. Now they say your amount will not be more than 5 lakh and 2,50,000. So the government is thinking on a right direction to do that. My purpose is, this is not the time to hide your income. Pay your tax, enjoy your life. White money will have the role to play in your life. That only will be helpful to you. Thank you. Any other questions?
Sir, I would like to open the house for questions. If I can take 2 questions from the house. Anybody would like to ask any question? Mike.
My apology for not there because that would have been a different story altogether.
Absolutely.
But you are in a hurry, I'm in a hurry, so that's why I was a little fast.
No problem, sir.
Hello. Sir,
Yeah.
conversion of stock in trade to capital asset is taxable.
Yes,
So, say,
taxable.
in case of conversion, if there is a loss, then that loss will be adjusted against other business losses.
The high point is income always include loss. So you are liable to pay tax under the house code. How can there be loss? That means cost is stock in trade cost, and the market value of that is to less. If it is, I have no problem.
Sir,
when income is taxable, the loss will also be allowed to you. Obviously, it will be allowed to you. Conversion of a stock in trade into a capital asset, if it returns into a loss, you are taxing the fair market value. Please, you are taxing the fair market value. You will have to even that. Now, suppose your cost is 3 crore. Now your market value is 2.5 crore. 2.5 crore will be income. But your stock will be reduced by 3 crore. So automatically loss will be adjusted.
thank you.
Are you understanding my point?
Yes.
3 crore is the stock value. Market value is 2.5 crore. You will tax on 2.5 crore, but your closing stock will go down by 3 crore. Automatically loss will be adjusted. Okay, sir?
Okay, thank you.
My target is
Yeah, sir, my question is whether cost of improvement and registration cost will be added in the cost now.
Now you have heard from Finance Secretary and social media. This is really a problem. Let me tell you, if there is a stamp duty which you have claimed reduction under 80C, then of course it cannot be part of the cost of place. But if you have not claimed reduction under 80C, nobody can say that this is not part of the cost. Revenue Secretary may not know many things. It will not be part of the cost. If they don't say cost, it will be cost of improvement. I am not able to understand why this statement has been given. As regard interest is concerned, why did you claim reduction under 24B? The interest is a deduction allowable under section 24B for the house property. Why are you calling taking it as part of the cost? But if it is land is not coming under house property, and you have purchased the land, whatever interest you have paid to purchase the land will have to be part of the cost. If there is no income derived from that land. If you have given the land on rent, that is a different thing. Otherwise, if there is no income derived from land, and you have purchased the land and you are paying interest will have to be part of the cost of the land, then let me take it.
Thank you.
Thank you, sir. Thank you, Dr. Ahuja, for taking out time from your busy
My
schedule.
apology again, but Sir Rajesh ji, abhi maaf kar dena. Thank you.
Thank you very much for taking out time for your busy schedule and sharing your words of wisdom. The second topic for the session is deemed supply and valuation, a Pandora's box. I now request C.A. Jatin Christopher to deliver his address.
Good afternoon, everyone. It's definitely a privilege to be here in Calcutta to share some thoughts about a topic that fiction has pervaded all legislations affecting business. When we look at deemed supply in GST, it requires us to take a step back and examine that fact is incompatible with fiction. Fiction is the antithesis of fact. When we deal with legal fiction, we will have to consider that the treatment of law is not being altered by legal fiction. The treatment of law is constant. The facts are being altered. The facts are being replaced with fiction, and then the treatment that is otherwise applicable is made applicable in the given case. GST is not free from legal fiction, and when we speak about supply, fiction in supply is undesirable because our experience in the earlier tax regime has shown that legal fiction will need constant refinement. Because the realities of trade will always not be compatible with the requirements of a taxing legislation. Many years ago, there was a young man who acquired rights to a film. He acquired rights to the film to produce it in a different language. The ingredients of this arrangement were such that the film would be produced in a different language. The economic gains from that production will be exploited, and after 49 years, the rights will be returned back to the original owner. Sales tax department was completely heartbroken to think that the entire economic value added and exploited will go untaxed. So they just could not believe this and said, in substance, this transaction is a sale, therefore sales tax has to be charged on this transaction. Madras High Court was very happy to say that sale in its simplest form is nomen juris. Sale is what the law defines sale to be, and for a transaction to be a sale, the form of the transaction should also be a sale, not merely the substance of the transaction. Decisions such as this led to the 46th Amendment to the Constitution. So India has experimented with legal fiction and lost consistently, and GST is that place where the learnings from those experiences have brought legal fiction to a very limited sphere of operation. Transaction value is the essence of incidence of tax. 8 specific forms of supply only attract this incidence. So therefore, there will be many transactions that will ensure economic benefits flow from one person to another, but tax may not flow to the state by those transactions. Failure to draft a dynamic piece of law is the need for support from legal fiction. GST has its share of legal fiction, but we have to bear in mind fiction does not permit extrapolation. Just like a case law cannot be applied in a context where it will not apply. A precedent, for example, a precedent is a precedent to what it explains as the law and the treatment to be. A precedent will not apply to what else it could also cover. Quite like that, legal fiction has to be applied very strictly, and legal fiction has to be given its logical conclusion as well. The earliest references to fiction in GST we will find in the definition of business itself, where volume, frequency, regularity and profit is not required for it to be a business. If none of these things have to be there, then how is it a business? If business has a fictional definition, we will find ourselves that supply also has a fiction. Because supply has to be in the course of furtherance of business. So our pursuit of identifying fiction in supply cannot be without identifying the fiction in business. Government is doing business. Very recently, few days ago, we've seen the 8:1 decision of the Supreme Court in Mineral Area Development Authority to say that royalty is consideration. Many years ago, Justice Krishna Iyer penned a very wonderful decision in Orient paper to say that royalty is a feudalistic euphemism for price. Later it was overturned in Titagar paper to say that forest lease is exactly that, it is lease of immovable property, therefore it cannot be subject to sales tax. Friends, we are back to the days of Orient paper. To identify for ourselves what is the price we are paying for, because there is fiction in demand and recovery also in GST. So we will have to understand what is the fiction in supply in GST, and the fiction occupies a small space. Everything is not fiction. Fiction occupies a small space And we have to locate where that fiction is, because facts cannot be forfeited and overridden by fiction everywhere. Facts will prevail everywhere. Fiction will step in only in those small gaps where drafting became impossible. We have a fiction in Schedule 1 of particular interest is the fact that a transaction between two offices holding different registrations belonging to the same entity is treated as liable to tax. If you see the 8 forms of supply, all 8 forms of supply are one or other form of contract. And a contract cannot be entered into with oneself is an inalienable truth. But with the fiction in section 25.4 and 25.5, it has become possible for a person to enter into a contract-like transaction with oneself. The need for this fiction is not because of raising revenue. It is to examine the federal nature of our structure so that states' sovereignty is not lost. States where consumption takes place also merit revenue that belongs to them to reach them. So please recognize that this fiction of distinct person is so profound that very often it can miss our attention. There are 2 circulars that came in, one July of 23, circular 199, and one in July of 24, 210, that sort of attempt to answer a very awkward situation that corporate India got itself into. When you have a transaction between 2 branches, it is liable to tax because the fiction of a distinct person requires taxable transactions between 2 branches of the same legal entity not to be excused or ignored. But when 2 branches have overlooked compliance with the transactions between the 2 locations, what is the remedy? The remedy is to give a circular to redress this lapse on their part. One location that made the supply will be holding on to all the credits, and the other location which enjoyed the supply will not have any more credits to utilize in its reporting its liability. Friends, please bear in mind that circulars seek to redress a situation. Circulars many times in GST we find are sort of coming in the way of legal fiction receiving its full force. So we have to recognize here what these 2 circulars have attempted to do. Very quickly I will bring this point for your consideration. I see on this platform of DTPA, members will be very aware of direct tax provisions, so I will rely on your understanding of direct tax provisions to help me put this GST point for your consideration. There is an entity in India and has admitted existence of permanent establishment outside India. The entity has conceded to the regulator of the foreign jurisdiction that out of its contracts for the year, a certain amount of revenue is attributable to the PE outside India and discharge tax in those foreign jurisdictions. That information is available in country by country reports available with the regulator. Although a different regulator, GST authorities have access to information reported to various regulators, like Girish was just mentioning about the 360-degree access to information. On one hand, assessee asserts to regulator of a foreign jurisdiction that there is certain income attributable to PE. How then can that income attributed to a PE at the costs deducted against that income not be a supply from that distinct entity back to the parent entity which entered into this contract? You cannot approbate and reprobate. You cannot say one thing to one regulator and then deny that very thing before another regulator. If you say sweet stall is supplying goods in GST and offer to pay 12 or 18% tax and claim full extent of input credit admissible on supply of goods, why then does this supplier go to regulators or under FSSAI or under legal methodology and say that these articles of food cannot have an MRP because they are not for further distribution, it's for consumption. So the friction in supply we now find in Schedule 1, 2 and 3 of GST law. 1 deems supply to exist when supply otherwise does not exist. 2, Schedule 2 says it is a supply but it will be treated as goods or services as dictated by the friction in Schedule 2, notwithstanding what the fact really is. So therefore, provisions regarding time and place of supply will be dictated by now altered fact by Schedule 2 and not based on the reality of those transactions. Schedule 3 is remarkable because it now does the converse. It says what is otherwise a supply will now be treated as if it was never a supply. Although we have friction in 17 to say that transactions which are not a supply will for purposes of reversal of credit be treated as an exempt supply. It is necessary because it's impossible. English language is at best an imperfect instrument of communication. We cannot say very clearly what we want to say, so we will lean on the crutches of deeming friction. We lean on the crutches of deeming friction because we don't know exactly how to extend the full force of what the law should be. 2 things which are extremely terrible for trade have come about because of Circular 199 and 210. 1, what was hidden is now exposed because of the circular. Inter-branch activity was not entirely reported or disclosed. If you see column 5J of 9C, it says 0. Inter-branch supply is 0. In most GST or 9C, it says 0. When we file any return, we are certifying the zeros in that return also. It's not that we are saying, I don't know. When we say something has to be certified and reported, whether by taxpayer now or taxpayer and chartered accountant in the past, when we file a return that says 0 in some column, mind you, we are certifying that it is 0. It's a positive assertion. It's not an abstention. I am asserting that I know that there is a transaction under inter-branch supply and I am certifying that it is nil in this transaction, in this entity, although there are multiple GST numbers existing. We cannot approbate and reprobate. If you see the definition of suppression, information required to be furnished, not furnished, tantamount to suppression. So therefore, please bear in mind, we cannot focus on what we need to fill in various columns in various returns that keep getting amended and refined constantly. We also have to keep in mind what we are certifying to be nil in the returns that we are filing. When we look at returns filed in foreign jurisdictions, we are making certain assertions there. My question is, how many GST transactions, practitioners in the field of GST have asked the client to provide a copy of their country by country report to examine what treatment is required for those transactions in respect of GST standards. I believe this thought with you to admit that Circular 199 and 210 have exposed domestic interbranch activity and 210 has exposed cross-border interbranch activity and said if full credit is admissible, then you don't need to comply with the interbranch requirement. I only have one grievance about this. Are all these entities who are relying on Circular 199 and 210 have no adjustment under Rule 42? Please bear in mind the condition to avail the relief under 199 and 210 is that your Rule 42 adjustment should be 0. Please take back this one question for those who are involved with taxpayers having multi-jurisdiction activities, please ask them. In Rule 42, T4 includes C1. T4 includes C1. If you don't even know what C1 and T4 are, it does not matter. It just does not matter. Please find out what is the effect of T4 including C1. T4 plus C2 is C1. I am talking in numbers because I know you will only carry this forward to have a detailed discussion. 199 and 210 have caused great heartburn to taxpayers with multiple GST registrations within India or having operations in multiple jurisdictions. Explanation to Section 8 of IGST law treats branches, project offices, liaison offices outside India to be a distinct establishment independent of the entity in India. Let me ask you this question. Is the legal authority and the financial capability to enter into contract existing with a PE outside India, or it exists with the legal entity inside India? Who has the legal authority and the financial capability to enter into a contract with a client? Is it the branch responsible for executing the project, or the head office which has the capacity to enter into such a contract? Executing contract is a matter of indoor management. Entering into a contract is what is responsibility of the customer to look into. So therefore it is for the head office to decide which branch will allocate, the execution responsibilities to. It is even possible for a head office to allocate execution responsibility to more than one branch office so as to manage risks better. Are all such entities having zero adjustment under Rule 42? And if it is not true, all such entities have some Rule 42 adjustment and they don't have the relief under Rule 28. So please consider, let's not rush to celebrate any litigation avoiding resolution that the government has to offer, because if you admit any relief, you are liable to comply with the conditions that go with that relief. We take a small example of corporate guarantees. There's a lot of discussion around corporate guarantees between parent companies, subsidiary companies, and joint ventures, and so on. When we debate valuation, we have considered supply. When we debate valuation, we have considered supply. One should not enter into debate on valuation unless we are sure that supply exists. GST is not a fringe benefit tax. GST is not a tax on benefit flowing from one person to another. GST is a tax on supply by one person to another. Education is provided. I was asking this question in a conference of GST covering various taxations to educational institutions and charitable institutions. Who is the recipient of education service? Most of the participants said students are the recipients of education service. This is where legal fiction comes in. Recipient is the one who is liable to pay the consideration. So education is supplied to the student, but education service is supplied to the parent. So therefore we will have to let go of commonsensical way of reading law to understand the fiction that exists in law, to identify how treatment needs to apply. And when we look at inter-branch activity, definitely there is room for an explosion of litigation relating to deemed supply. Please also bear in mind, deemed supply is a small subset of transactions that take place in business, because law cannot adequately capture, using the imperfect instrument of English language to bring these transactions to tax. It takes help of the crutches of fiction to bring it to tax. So therefore we will have to recognize what the crutches are and what is the limits to this crutch that the law has relied upon. When we look at Schedule 3, to say what is not a supply, it uses the word supply. How remarkable is that? To state what is not a supply, Schedule 3 requires to use the word supply and then say that such a supply shall not be treated as a supply. So please consider, whenever a treatment of law is required, then the treatment will be that it is not a supply, but not when any treatment is not required. So therefore, to disclose whether it is your aggregate turnover or not, all those transactions also come within the scope of reporting. Whether or not the treatment required will be eclipsed because of Schedule 3, we also have to recognize the ingredients to fit. Government of Kerala versus Mother Superior Adoration Convent, Justice Nariman has rendered a wonderful decision clarifying the boundaries of Collector of Customs versus Dilip Kumar also to say, to claim an exclusion, the burden is on a taxpayer. 103 of the old evidence law, if there is something to say that I am excluded from the scope of operation of the normal treatment in law, the burden is not on revenue. So revenue can simply sit back, kick its legs up and say, I deny you the benefit of Schedule 3 exclusion unless you can bring home evidence to substantiate that this is covered within the scope of the exemption. I'll give one example. Sale is a transfer with free will. When there is compulsory acquisition of land, is it a sale? Because para 5 of Schedule 3 says sale of land is covered by Schedule 3. What about compulsory acquisition? If compulsory acquisition is not sale, then it is not also an exempt supply for Rule 42 reversal. So we will have to be very careful whether we have recognized the fiction in allied laws, whether that fiction travels into GST or the fiction stays within that law. Many times when we have fiction in allied laws, for example, 231 of income tax law says, for the purpose of this act, a partnership firm shall be treated to be a person. Which means for purposes of all other laws, including partnership act, a firm is not a person, it's a collective. But we take the fiction and extend it to places where it is not supposed to apply. We have a fiction in section 71AA of GST law that says transaction between a club and its members by fiction is a supply. But the principle of mutuality has remained undisturbed in income tax law. So therefore we will have to recognize the boundaries of this fiction. If we fail to recognize those boundaries, we will imperil ourselves. Many times I find taxpayers are asked to provide the facts. I request all members to kindly consider that taxpayers are not in a position to provide facts. Taxpayers are at best in a position to furnish information. It is for the tax consultant and the tax authority to distill that information and extract the facts out of it. Because many people think holder of an agreement has some rights. Many times we see transactions where someone enters into an agreement to purchase an apartment, has paid some money even, and says he now has a right and which he is going to transfer, and the tax authorities are happy to bring this transaction into taxing, tolerating an act or a situation. The law is very clear in section 54, holders of agreement have no right in the property. All that a holder of an agreement has is a right to demand specific performance. Nothing else. They have no other right, but here we are happy to bring this within the scope of supply. What's worse is there is a circular even that says 172 to say that breach of an agreement is compensation not liable to tax. I suppose we are losing sight of first principles. The excitement to compute tax seems to be getting the better of us, that are forfeiting inquiry into whether it is a supply. If it is not even a supply, there is a question of computing the tax. But the tendency of taxpayers is to give a reply on all aspects involved. But if the first question itself has not been answered, what should be done for where is the occasion to enter into any other questions? So therefore, please recognize there is friction in other laws that need to be identified, whether it will travel beyond and enter into GST, or whether that friction is to apply only within the confines of that other law and have no place in GST. Both sets of possibilities exist. There could be a friction in income tax law that has no application. For example, 47 in income tax law is a friction to say a transaction which is not a transfer. The need for a friction is because fact is not of great assistance in that case. A transaction which is a transfer finds mention in section 47 so as to not give rise to the consequence of the treatment attendant to transfers. A transfer which is not a transfer will never find a mention in 47. A transfer which is a transfer is what will find a mention in 47. So when a transaction is declared in 47 of income tax law not to be a transfer, it is very much a transfer for purposes of GST, and we have to examine those transactions whether they have been given the applicable treatment in GST law. A taxpayer goes to a regulator and reports MRP on a product, Legal Methodology Act. He reports to the regulator that this article has an MRP, but in GST he reports that he is giving it away as free samples. Medicines which are meant for distribution as free samples will not have an MRP. Medicines which are meant for distribution to physicians will not have an MRP, but the question is, giving away medicines to a physician, is it distribution of sample? Please bear in mind, the language in section 17(5)(h) very clearly says gift or free sample, but the words gift or free sample have a qualification. It talks about disposal by way of gift or free sample. Gift and free sample are two modes in which disposals are done. Articles that are fit for sale will not be disposed. Articles that are unfit for sale only can be disposed. How can articles unfit for sale can be given away as free samples? Does it mean that they are not fit for purpose? Fitness for purpose is different from the manner of presentation. You've seen perfume bottles which are given away as samples in a tester pack. It is of such a small quantity that it is unfit for commercial use. Therefore, it is a sample. But are medicines given away to physicians unfit for use? If it is unfit for use, the pharmaceutical company and the physician will both be in trouble. It is fit for sale but not meant for sale. It is fit for sale but not meant for sale, so therefore it is not suited for disposal. It can never be complied by reversing credit. It is subject to output tax because it is given away to the physician. It is not given away to the patient. It is given away to the physician in the course or furtherance of business and for consideration. The word consideration in 231 is defined very beautifully in Hindi, better than English. It says pratibhal. In response to, in respect of, or for the distribution of. In order to bring about a supply, whatever is the reciprocity that takes place, that is consideration. The word used in, again, in Hindi language is utprerna. Utprerna. The pratibhal for the pharmaceutical company exists or not is a question we have to answer. Because if it exists, then there is consideration. 231B talks about consideration in non-monetary form. If they give it away as free samples and say I have not received consideration, 122 of Transfer of Property Act is very clear to say gift is a transaction without consideration. Gift is a transaction without consideration. In GST, if you say it is a gift, we are trying to say that there is no consideration, then deduction should be claimed under Chapter 6A and not Section 37 of Income Tax Law. How can we contradict ourselves? In GST, we will say it is a gift, and in income tax, we are claiming this under 37(1)(7). So, therefore, please bear in mind, we have contradicted ourselves. In GST returns, we are saying one thing, in income tax returns, we are saying completely different things. We have to be very clear because when we file a return, The perils of self-assessment is that we are responsible for the self-assessment we carried out. In income tax we do self-assessment, in GST we do self-assessment. We cannot assess our liability differently because the source transaction is the same. The underlying transaction is the same whether we offer it in income tax for some treatment or in GST for some other treatment. The fact is really the same. The treatment will be different, but the fact cannot be different just because the regulators are different or the regulations are different. We look at another aspect in GST, very interesting, that we have to consider how these transactions will now need to be put through, because GST relies greatly on assessor's own disclosure. Friends, please bear in mind, today we have seen a very rudimentary form of litigation. We are already heartbroken at the exploding scene in litigation. We are seeing rudimentary litigation. Data differences are the bulk of litigation. Data differences form the bulk of litigation. Today, nobody has even applied their mind to substantive questions that have not yet been examined. Substantive questions have not even been examined. Agricultural products, there is a rice mill. West Bengal has been somewhat in the center of these discussions in the past also. A rice mill receives paddy, converts it into rice and returns the rice back to the agriculturist. The transaction of milling is liable to 5% GST of food articles covered by chapter 1 to 22 of 1/17. But please bear in mind, 268 defines job worker as someone who is engaged in treatment or process on goods belonging to another registered person. Is the agriculturist a registered person? Answer is no. If the agriculturist is unregistered, then the job worker is not a job worker. And if the processing is not amounting to job work, then rate of tax is not 5%, it becomes 18%. If department says they want to collect tax on job working, they will have to demand tax at 13%, but they can't demand tax at 13% because there is no 6.5 rate of tax. They have to demand tax of 18% all over again and appropriate the 5% tax paid under a misinformation due to classification error. Extend this example a little further. The job worker also sells bran and husk that is generated during process of job working and pays tax on bran at 5% and husk at 0%. Reported all the turnover, there is no concealment, there is no hiding. It's just that the taxpayer does not have insight. Taxpayer has information, he does not have facts. Taxpayer has information, he does not have facts. He does not know that the bran that he is selling, it is not his to sell. Nemo dat quod non habet. He who does not have cannot give. Section 55(2) of Transfer Property Act says, a person who has no title cannot confer any title to the transferee. What is the title to the bran that the processor has? The paddy belongs to the agriculturist, the rice belongs to the agriculturist, therefore the bran and husk also belong to the agriculturist. So therefore, money realized from disposal of bran and husk is additional consideration towards job charges and not transfer of and not supply of goods. If they have discharged 5% tax on bran and they could not have, because if you say there is a sale of goods, please show me where is the purchase of goods. There is no purchase, so there cannot be a sale. And if there is a sale, then it is a demand under 76 to forfeit the money collected in the name of tax. And this job worker will be liable to full rate of tax on the entire money realized from sale of bran and husk, and at 18% because he can't get adjustment of the 5% because that is a demand under 76, this is a demand under 73 at least, if not 74. Whenever government passes the time limit under 73, they fall back on 74, hoping that allegation of suppression can be sustained in later proceedings. So friends, please bear in mind the realities of business are becoming less and less relevant to guide the treatment in tax law. Tax law identifies the ingredients from business and creates its own fact pattern. Tax law creates its own fact pattern to decide how it has to be treated. Interesting provisions in section 81, 85, 87 and 93, very briefly I will touch upon it because it touches supply. It touches supply by friction. 81 says where there is a transfer of assets with the intention to defraud revenue, then at any point in the future, GST authorities can annul the transfer. There is a proviso to 81 that says additional commissioner is designated as the proper officer who has the authority to grant a no objection certificate before you proceed with the transfer. All those transactions where M&A is being done need to get a NOC from additional commissioner that the purpose of this transfer is not to defraud revenue. Whether revenue is involved and whether revenue will get defrauded in the future is not something that can be determined at that time, but additional commissioner is the one who is going to give NOC, and there is no guidance in the statute as to on what basis this additional commissioner can give this no objection also. With that said, in 81, we look at 85. When there is a transfer of business in any scheme of arrangement, as we call it in Companies Act, when there is a transfer of business, mind you, the transferor and transferee are jointly and severally liable. What are they liable for? They are liable for dues of the transferor determined subsequent to transfer. Dues of the transferor determined subsequent to transfer, transferor and transferee are jointly and severally liable. I have a grievance about this. I will bring this to your attention in just a moment. I will touch upon 85 and 87 and 93 and then come back to this. 87 says between the effective date of merger, demerger, all those schemes of arrangement, between the effective date of merger and the actual date of merger, transactions between transferor and transferee does not require to be reversed. Alright? Although Income Tax Companies Act requires the returns to be revised, balance sheet to be restated to restore the transaction to what it should have been based on the effective date of this transaction, GST law says leave it as it is. We will not disturb this. Again fiction here. In income tax law, it is turnover of the transferee. In GST, it is turnover of the transferor. In a GST, it is input credit of the transferor. In GST, it is input credit of the transferee. Going concern will not be a going concern if all assets and liabilities are not transferred. If input credit has already been exhausted, can we say that all assets, including input credit, have been transferred or not? The only way revenue can raise this question is you did not make a claim under Rule 41 for transfer of closing credits. If credits have not been transferred, how is it a going concern? Because of Supreme Court decision in Mother Superior Adoration Convent, burden to prove that the exemption is applicable falls on the person claiming the exemption. Is it possible that show cause notice can be given 2-3 years after the transaction? Is it possible that, and should this show cause notice be issued to the transferor or to the transferee? Section 93(1) A and B particularly talks about succession of business of a individual. Succession by transfer or by death. Where the business succeeds to the legal heirs, and this is very important, I think definitely DTPA is the most well-informed platform to place this question for consideration. Where there is succession in business, let's say due to death of proprietor, if the business continues, Circular 96 says the legal representative, let's say the daughter continues the business of the father, the daughter will be liable to discharge dues of the father, dues to be determined subsequent to demise also. So which means that daughter can receive ADT1 for the year when she was still in college and the father was alive. How can the daughter answer questions later which become allegations in a notice and offer a reasonable defense of matters she has no personal knowledge of? 93(1)B says in case of death and there is the absence of any continuation of the business, the liability determined subsequent to demise of the proprietor can be recovered from the legal heirs. Friends, I now place this question for your consideration. I've had the occasion to look at CPC and 159(2)(b of income tax law. Order 22 Rule 1 of CPC very clearly says, debt abates all things unless the right to sue survives. Let's say there is a property dispute. Mr. A is pursuing the dispute, and during the pendency of the suit, A dies. Legal heirs can be impleaded because the right to sue is a heritable, because the right that is in dispute is a heritable right, so therefore legal heirs can be impleaded. My question to you is GST liability something that will be inherited by the legal heirs? The recovery is from the legal heirs, but is that liability inherited is a question. Now to answer this question, we have to compare with wisdom that is available in other laws. 159(2)(b, I had a chance to briefly look at it, but members here will have a more intimate understanding of that provision. In case of death of a taxpayer, the law says that the proceedings initiated at that time during the lifetime of the taxpayer will be deemed to have been initiated against the legal representative. I mean, it's a remarkable fiction. It's not just a light fiction, it's like a Star Wars level of fiction. 159(2)(b, I don't know why nobody has challenged it. I asked a direct tax practitioner, very experienced person, said, why hasn't anyone challenged this? It's been around since 1961. That is, 2024 is the reason to disturb everything that has been around for a long time. If we were to say that the notice issued to the person during his lifetime is deemed to be a notice issued to the legal heirs, which means during the lifetime of the person, the notice was issued to two people. To the person who is now deceased and the person who has now succeeded. At that Star Wars level of fiction this is. We don't have that fiction in GST law, so I place this point for your consideration because we have a stunning new and irrelevant section 74A that has been introduced in GST law. I'll place this for your consideration. A notice of demand in GST can be issued to a person chargeable with tax. Mind you, not defined. Notice of demand in GST can be issued to the person chargeable with tax under chapter 15 of GST law. Section 93(1) identifies person liable to discharge the tax. Friends, please find here. Do we say that the legislature thinks person chargeable with tax is the same as person liable to discharge the tax? 93 talks about who is the person liable to discharge the tax. 73, 74 and 74A talk about person chargeable with tax. How can person chargeable with tax be substituted to be the person liable to discharge the tax? If the legal heir is supposed to pay the liability determined against the person chargeable with tax after the demise of such person who received the show cause notice. So we had one instance where department sent a show cause notice to the wife of the late proprietor. A show cause notice was sent to the wife of the late proprietor. The chartered accountant got excited and entered appearance. He called for a clarification saying that regarding the merits he had some clarification. Sometimes it is good for people to get a doubt. If they don't get a doubt, then there is no possibility of identifying some serious mistakes being committed. So during that conversation we asked, so what happened to where is the proprietor? So the proprietor died 2 years ago. Then who are you representing during these proceedings? That proprietor. Please bear in mind, there is something very clear about death. Death abates all things. Agent can only do what the principal can do. Now that the principal cannot do anything, the agency is terminated. It stands terminated. So I told him, look, the authorization letter which you may have collected from him then has expired upon his expiration. So therefore you are no longer an agent, you are no longer a representative. So what should I do? Write a letter, inform the officer that the agency has now been terminated under 209 of contract law. It is the responsibility of the agent to preserve the assets of the deceased principal. Do whatever it takes to make sure that as an agent you are not in dereliction of your duties. Inform the department and then stop attending. What about my fees? I have no answers to those questions. Not all questions have answers. It's only good to know what those questions are. So what should be done? So the wife wrote a short letter to the department saying that, dear sir, a show cause notice addressed to late husband Mr. So-and-so has been delivered to the residence. The notice has been delivered unserved. Officer was perplexed. If it is delivered to the wife, then it is served to the husband. She said the wife is no longer in a position to in turn serve it to the husband, so you are welcome to serve it to the husband. The entire demand is rested at that stage. We have recourse to substantive law. Sometimes we are so filled with information. We have so many answers. We know how to do the reconciliation. 2a to 3b, R1, 3b, 9, 9c, 2b, 3b, 3b, 4b. कभी-कभार data credit reconcile भी कर जाते हैं. We are so good at doing reconciliation. But please bear in mind, sometimes the right thing to do is to not do anything. So therefore, please consider, where is the fiction in chapter 15? 74A is supposed to bring updated thought. Where is the updation? How can person chargeable with tax be substituted with person liable to discharge the tax? There is a recent decision. I'm sure Calcutta also has some judgments on this issue. Trelleborg Private Limited, Karnataka High Court, notice is issued to a company that has been merged. A has merged into B. Notice is issued to A. High Court set aside the notice issued to A and said respondent free to pursue remedy available against B. But B was never the taxable person back then. Therefore, there is tremendous safeguard in the factual position that fiction has to be given its deserved extent of operation and not given unlimited operation. So when you look at these aspects, we find some remarkable new fiction. We find in GST law. Section 11A proposed in the GST law. Section 128A proposed. 11A basically is a provision that says, I know what is supply, now we know it better. Transactions that were fitting within the definition of supply, both of us may have made a mistake. You didn't pay tax, I didn't demand this tax from you. Let's not make a big deal of it, let's drop it. So the new section 11A proposed in this law to say that whereas a trade practice taxes have not been discharged, government now has the authority, based on the recommendation of the council, to grant accord. It's not waiver. It's accord. I agree not to pursue you and will leave it as it is. I agree not to pursue you, let's leave it as it is. This is not a very graceful thing to have happened. There are more things that are going to happen here. If you were to take a guess, how much do you think could be the liability that will get, or that will not go into collection because of section 11? The show cause notices on gaming have crossed 1 lakh crores, won't be collected. 2 new entries inserted in schedule 3 to say transactions which will not be treated as supply, but in this proposal itself it is not being given retrospective effect, so there is going to be another reason where insurance and reinsurance business is going to fit within 11A to see how tax will not be collected. So therefore section 11A is going to cause some great anguish. If you take section 128A, there's a lot of cheer. If you have a fan of this new provision, if you've been having a discussion, please consider what is being forfeited here in 128A. There is a legitimate due. That legitimate due has been acted upon and the law set in motion by issuing a show cause notice without any allegation of malafide. When there is a liability to tax, the liability will also take with itself liability to interest and minimum 10% penalty. Whether minimum 10% is lawfully sustainable or not is a different matter, but minimum 10% penalty also goes with it. So here is a provision that says even though the law has been set in motion, the government wants to forfeit this interest and penalty if the principal is discharged. It is not a case where there is a liability that has escaped attention of the regulator, unlike Sabka Vishwas scheme, where liability that was under voluntary category also permitted to be disclosed and discharged. Here we don't have a provision where unknown liabilities are going. So this 128A is not to garner revenues and to give quietus to proceedings. 128A is a provision to abandon proceedings that have been lawfully initiated. Interest has exceeded the principal liability. Interest has exceeded principal liability. Large-scale notices have been issued in the last 3 years on various grounds, based on data differences, based on audit findings, based on investigation. On variety of grounds, notices have been issued, and if statistics available in public domain is anything to go by, someone even put this number as, when the tribunal is set up, there could be as many as 1 lakh cases waiting to be filed once the tribunal is set up. If there are that many cases, I mean, even leaving aside 16.4, if there are that many cases to be filed, where matters have progressed from show cause notice, first appeal, and perhaps even waiting to go to tribunal, here is 128A that says by forfeiture, government says pay the principal, I don't want interest and penalty. The cost of litigation cannot be that much. And if the amount forfeited will be equal to the amount collected, I wonder what the collection will be. And the information, it will come out in public domain at some point when the scheme is launched, once the scheme is concluded, some statistical information will be available. Please bear in mind, the entire society of tax-paying citizens will have been wrong because of this one provision. And today, if I were to hazard a guess, my guess is at 15 lakh crores. 16.4 is estimated to have a demand of over 1,45,000 crores, and that's going to be given quietus by introducing 16.5. But please bear in mind, these are all provisions where no disputes exist as far as the law is concerned. The taxpayer may be willing to litigate it, but now the regulator says he is not interested to litigate, and that is remarkable. The reason why we have to recognize the role of fiction is fiction operates within a small subset. Fiction has a very small sphere of influence. The sphere of influence that fiction has is so stunning and overbearing that it has a tendency to fertilize and pollinate the rest of the law. We have to bear in mind that GST is a 21st century legislation that is India's pride and the world's envy. We need to, members in this August gathering, need to have mastery over the subject to recognize the exact area where supply will apply, because GST is something that's going to see us generate so much revenue that is required for the development work. We've seen all the forecast of the government as far as what new activities are yet to be carried out in the future, but we will find that GST is going to be, its contribution to revenue generation going to be so significant. As we look forward to what lies ahead in GST, effective August 22 and thereafter, data difference and demands related to data differences nearly be no differences as far as data is concerned. All disputes will now be the real ones that we will have to concern ourselves with. Going forward, we will see a growth of litigation, and I see many decades of ambiguity continue to exist, because it's only now that both sides have started to examine what is supplied and what is deemed supplied. And if we recognize that deemed supply exists in multiple places, it's not just in Schedule 1 business, to what is deemed not to be a supply in Schedule 3. Therefore, we will have to continue this deliberation, and there can be no better platform than DTPA. Interpretation is for professionals, for us to examine, for us to debate, for us to raise questions. Earlier, Ankitji were talking about what steps Calcutta is taking in reshaping this law. The whole country is looking at Calcutta. The whole country is looking at Calcutta because there are several areas where Calcutta is leading the charge. If Bangalore can claim to be leading the charge as far as development of law in the technology space is concerned, Calcutta is leading the charge in several other sectors. So my question to Calcutta is, what are we doing to reshape this law, the due process, the strength of self-assessment by taxpayer, and the limitations of law that apply not just to taxpayer but also to tax administrator, because what prevails in GST law has nothing to do with computation. What prevails in GST is that the law rules above everything else. I thank DTPA for giving me this opportunity and all members for your participation. Thank you very much.
Thank you very much, sir. DTPA is releasing a GST publication, Critical Issues on GST with Judicial Pronouncements, under the chairmanship of Advocate Ankit Kanodia. I request C. Jatin Christopher to kindly release the publication. I request Advocate Ankit Kanodia, Chairman GST Research and Publication, and Co-Chairman C. Sahib Singh Chaudhary to join the dais. So we have 5 minutes for question and answer. So if there is any question anybody wants to ask, can ask. Any questions from the house? Please give the microphone.
Sir, I have one question regarding this ISD and cross-charge. So, sir, now with the ISD becoming compulsory, not yet notified, for example, if we take a situation, I only have a unit in Gujarat and my head office is at Bombay. So, now I had taken a registration in Bombay for the purpose of cross-charge, for the purpose of managerial services which the management sitting at Bombay is supplying to the plant. So we are doing a cross-charge. Now with ISD, whenever the ISD becomes compulsory, so I need to have the ISD registration for my head office also now?
My view is that ISD is not compulsory. ISD amendment only reiterates what the law already was understood. Head office is not merely an office that receives invoices and distributes credit.
although many may think that head office में ज़्यादा कुछ काम होता नहीं है, but legally head office provides what is referred to in the banking FAQ as management, supervision and oversight service provider. So a head office may not be actively involved in trading or providing services that the business does, but the head office is very much providing management services to its other distinct persons. So therefore, head offices particularly should not operate under ISD. They should continue to operate under cross-charge to distribute credit. The risk of head office flipping to ISD is head office will invariably have non-creditable cost components which will not go into valuation. Therefore, unless, like I said, C1 is C2 plus T4. So therefore, branches will all not get the relief under Rule 28. So please choose ISD very carefully. To me, the litmus test of whether it is an ISD is the location where ISD registration is proposed should have no capability to provide supply. It should be incapable of outward supply, then and then only should it be ISD.
Thank you, sir. Any other questions? Arun?
Easy question, please.
So as you were sharing about the show-cause notice to be issued for the deceased person. So in that case, if the show-cause notice cannot be issued in the name of the person who has already passed away, will 93 1A and B not be infructuous?
Absolutely. 93 1A and B will be a vestigial organ in this law without the substantive provisions being covered in chapter 15. If there is no power to issue notice, how can the legal representative be dormant during adjudication? Can adjudication continue against a deceased person? Can adjudication be carried in appeal by the deceased person? No. So the proceedings have to abate. So therefore, unless amendments come about in chapter 15, 93 will be a inoperative provision. But many times the excitement that legal representatives have, they will rush to file replies in respect of notices issued in the name of the deceased. And officers, when this is brought to their attention that notice cannot be issued in the name of the deceased, they are happy to issue notices in the name of the legal heirs. But legal heir is not a person chargeable with tax. Legal heir is only a person liable to discharge the tax. So there are a lot of lacunae.
Thank you.
The last question.
KOLKATA, so many so-called notices are issuing, multiple for 3 years. Suppose 21, 23, 23, 24, 24, 25, in this way. Now, Superintendent, they are saying that these notices are not issued by us. These are issued on the guidance of artificial intelligence. That is a mechanism they are guiding and they are issuing from the central, not from KOLKATA. So what is the mechanism? Please clarify.
Revenue is free to issue a notice when they have material to indicate that the self-assessment is incorrect. Whether department relies on natural intelligence or artificial intelligence, the notice does not change its character depending on the source of such intelligence. Because over time, natural intelligence perhaps has become less dependable. That assistance of artificial intelligence is taken. And whether the officer knows this or not, it is his notice. It is his notice. He cannot say it is not my notice because it is issued under his authority. So therefore it is his notice. They rely so much on data analytics only to collect the base material on which to construct these notices. So therefore it is very much a valid notice that merits to be replied in accordance with law.
Thank you, sir. Sir, last question.
Sound.
All right. All right, I'll repeat the question. There was a notice issued to a person deceased. The legal heir went to court and court set aside the notice against the deceased and directed the respondent to issue notice to the legal heirs. We have to bear in mind the court granting liberty to the respondent to issue notice to the legal heir is different from the court directing the respondent to issue notice to the legal heir. The court merely set aside, consequent to setting aside, gave liberty to the respondent to issue notice. But please bear in mind, to issue a new notice, new limitation will start. 2, there must be a provision in law to recognize legal representative as person chargeable to tax. I would feel the second part of this direction of the court is dead letter. It has no legal basis. When the statute does not allow proper officer to issue notice to legal heir, how can the directions of court substitute the gaps in the legislation? So therefore, the legal heir has nothing to worry about. Department can never issue a show cause notice to the legal heir because legal heir is not the person chargeable with tax. Most important, department needs to first make a determination who is legal heir. Who is the son and daughter are not automatically legal heirs to receive notices. Therefore, with good reason, Chapter 15 does not have any machinery provision. Unlike income tax law, in GST law, with good reason, I don't think it is legislative oversight. With good reason, there is no provision in Chapter 15 to issue a notice against the legal heir or create any fiction. Legal heirs transferring of a business where the transferor has been liquidated, please be very careful. By participating in proceedings, it is with great risk and peril. Not even by participating in non-existent proceedings, bring legality to those proceedings. At any stage, a legal representative can wake up, realize rights and inform that those proceedings need to be dropped because it has no validity in law.
Next question, Shivani.
Not possible, sir. Not possible.
Shivani, the last question for you.
So very good afternoon. So you spoke briefly about club and association services. My question is that even after the amendment in 71AA, today the GST which is collected and paid by clubs, is it valid in law or is it under the deeming fiction, and you would say we still have some grounds to challenge the levy?
Wherever there is transaction between club and its members for monetary consideration, there is no doubt. Because the expression in 71AA also says cash deferred payment or other valuable consideration. Any non-monetary transactions between club and its members are not even covered by the amendment. So therefore, they have overcome the mutuality concept only where there is monetary consideration and not other.
Thank you, sir. So, the two publications that have been released today, the income tax publication and the GST publication, can be collected by all the delegates by giving the publication coupon from the registration desk. Post lunch, 2 o'clock, we will have the quiz. There are a lot of exciting prizes for the quiz. Lucky draw coupons may be dropped into the box which is at the registration desk. The lucky draw box will be removed at 3 p.m. So request everybody to kindly drop the coupons before it. After the vote of thanks by Shyam Agarwal, we are going to break for lunch and be back sharp at 2 because the next session starts sharp at 2. Sharp vote of thanks, please.
Good afternoon, everyone. So we bring to the end of enlightening first technical session, and I, C. Shyam Agarwal, Joint Secretary DTPA, would like to extend a heartfelt gratitude to all this who made this event a great success. First, a sincere thanks to our distinguished speaker, CA Dr. Girish Ahuja ji, who represented on deemed income versus real taxes. In spite of his urgent government call, he could not attend today, but he made sure that he gave his deliberation to all the participants. The more you listen to him, the more the fan we become. His deep dive into the distinctions between deemed income and actual tax obligations has significantly enhanced our understanding of these complex issues. Secondly, we are grateful to our speaker, C.A. Jatin Christopherji, all the way from Bangalore, who has tackled intricate topic on deemed supply and valuation. Your thorough exploration on the challenges associated with deemed supply and its valuation has opened our eyes to the complexities involved in it. Your analysis has clarified many of the nuances that surround this often perplexing subject, offering us valuable perspectives and practical insights. And to all our delegates, your active participation and thoughtful questions have greatly enriched the discussions. Thank you once again to all the speakers for their time and expertise, and to our delegates for their enthusiasm and involvement. We are breaking for lunch as told by Ritesh Kumarji, and we'll get back here sharp at 2 o'clock for the quiz competition. Thank you.
না না